There we go. Hey, everyone. Welcome back to the MHP Show podcast. I'm your host, Derek. As we always do, we talk about real estate investing and all aspects of that and this business in particular. And I'm super excited to be here today. And I just wanted to give a shout out on Thursday, the 27th. We're doing a deal underwriting webinar. We're going into all the basics of underwriting because I get questions weekly about, hey, Derek, I'm looking at a deal. How do I value these vacant lots? How do I value these abandoned homes here? How do I value the storage units or the boat docks that the park comes with? Because these parks come with crazy stuff, right? And so we're going to be going through that. We're going to be going through that on Thursday in depth, in detail. I'll be on there an hour at least. And we'll have the link in the show notes so you can join that. It's completely free. Would love to have you on. It's going to be freaking awesome. So today I have with us, you're kind of a legend, Kurt. I mean, I know you've been around the business for a bit, and Kurt is an insurance expert. He's the president of Mobile Insurance. So I'm super excited to have Mr. Kurt Kelly here with me today. How you doing?
Good, Derek. It's good to see you. I hear your name all the time, so it's nice to actually visit a little bit more in person.
Yeah, good. I hope it's good stuff. I hope it's
It
good stuff
is. It
only.
is.
Good. Yeah, and so it's interesting. I've got a lot of stuff that we can chat about here today, and insurance. I actually used to be in the insurance world, not the commercial insurance world, but like health insurance, and so I know somewhat how the business works. Not nearly as versed on it as you are, but when people think of insurance, like it's like, oh, it's a terrible word. And you've been around this business, mobile home park specifically, for how long?
Well, almost 30 years, right? 28, I think.
Yeah. Because I remember listening to Frank, some of his old recordings, and you may have been on there for
Yeah.
one. Yeah.
Yeah, I've
So how
done
did
business
you?
with Frank for years, so he's been a good partner like you. He does a lot of great things like you do. Shares good knowledge. He gives basic good information to people, and like you, when you call him, he calls you back.
Yeah, for sure. So what made you like? How did you get into the mobile home park business as far as like insuring them and doing that? Because I doubt it was something you went into like intentionally, or maybe you did.
Yeah, childhood dream of mine
Of
to be in
course.
mobile home park insurance. In fact, it's actually kind of an interesting route. Years ago, General Electric was the 21st of the finance world of mobile homes. Some people know that. And my little company was owned by General Electric in the early 90s, like 91, when they decided to quit wholesale, quit the manufactured home financing altogether. And when they did that, and my stepfather was running mobile monogram at the time, he just bought what was left of the company when they decided to close down the whole division and run it. So that's where that started. And I had was practicing law in Western Oklahoma in the midst of everybody's divorce and everybody's criminal trial. And that's a long, hard life. And then my stepfather talked me into coming to work for Mobile after about 5 years of trying cases and with DUIs and guys that beat up their wives and divorces, which is a miserable existence.
Yeah, I can imagine. Yeah, it doesn't sound like a fun world to me.
Oh, good stories, but not fun.
Yeah, I'm sure you have some good stories, and who knows, maybe I'll ask you about
Yeah.
some of those stories. But when people, we're talking about insuring your mobile home park. You're buying your first deal or whatever, right? What do you think? Like, what should you have? Like, what coverages should you have on your park? Because I've heard different things. Like, hey, you should over insure the thing, but then that could potentially kill your NOI. And then if you under insure it, you're a little bit at risk. So I'd love to hear your opinion on that.
Well, I think there's something to that. I think I don't usually tell people to buy giant limits of coverage, and there's two reasons for that. One is I'm a businessman too, and I like my ROI, and I don't want it to be leveled off by it because I bought too much insurance. But what I also found, I think, is kind of an interesting phenomenon. When we've had these awful, terrible events that happened. If we had $2 million of insurance, we settled it for 2 million. If we had 4 million, we settled it for 4 million. If we had 5 million, we settled it for 5 million. So in some ways, and it's not always the case, when you get a ton of equity, you've got to be a little more careful with this. But in some ways, the more coverage you get, sometimes you're just feeding a plaintiff lawyer group. If you've got a 2 or 3 or 4 properties, you got them leveraged 70%, 60%. There's nobody that really wants to take that on from you. They'd rather have $1 million or $2 million cash from Kurt Kelly and leave you alone and not have to work at it. So it's a little bit of a dangerous philosophy, but certainly mine, because I'm a businessman. I spend a lot of money on insurance myself, and I'm sensitive to it.
Yeah. Yeah. Yeah, I mean it's like it's a double-edged sword, if we want to, spend a lot of money on it, we can, but if not, there's like a there's like a healthy balance of that because you got to have it. Obviously, if you're doing deals through the bank, they're going to make you have it for sure. What is the, it's a big topic now. Insurance rates are, blowing up, especially in multifamily, around the US. What's driving that mostly?
A lot of things. It's inflation. So what used to cost $10,000 to repair now it costs 20. What used to cost $1 million to build now costs 2 million. It has to do with insurance companies were maybe underrated for a while, and they had multiple years of losses. And when they had multiple years of losses, they were having to spend their own capital to throw into these loss issues in order to stay afloat. Well, that meant there was less capital to support more insurance. So from the course of, say, for instance, from the year 2020 to the year 2024, the amount of insurance needed to insure buildings is up 70%. Because that's what it costs. That's how much more it costs to build and do things and repair things. Plus, more stuff is out there. So that alone was a huge deal. Then we've got this continued phenomenon in the United States, which we're pretty much the only country that does this. We sue everybody for everything. And juries are constantly given, well, Derek Vickers has got to be ultra rich because he's got a great haircut and he was on a real estate show. So we're going to hit him for 50 million. And so juries don't stop at that. So those are all factors that are going into this deal. But it's really resulted in the tightest insurance market in my lifetime as far as selectivity and cost. And so it just makes it to where it used to be kind of a back burner deal. Now you really need to make it as part of your strategic plan.
Yeah, that's interesting because even if you're in Florida, I'm in Florida. So you drive down the major highways and there's billboards. So and so got me $4 million.
Yes.
Johnny got me $4 million for this and that, and it's bad, and it's even worse in South Florida. And unfortunately, I could see why that's driving the costs up. And then I'm assuming too, like some of these catastrophes, like Hurricane Ian that came through Fort Myers and just leveled everything. I'm sure that's having an impact on it as well. But what you said makes sense.
I looked at the 5-year period of losses for catastrophic losses. If you look at the 5-year period previous to this, we averaged about $83 billion of catastrophic losses in a year. And if the previous 5-year period, it was like 25 billion. So I think there is something to do with the weather changing, weather patterns changing. But I think it's got more to do with there's just a lot more of us. There's a lot more property. It's a lot more expensive. And so when things are hitting, it's just costing a lot more.
Yeah. And that makes sense. And I think some people had the misconception, even I did for a little bit, that it just was like, okay, the weather is worse. There's been more, people filing claims due to weather things, but definitely here in Florida, I can see the litigious environment that is crazy. We don't have to get into that, but we surely could probably talk about that for a second. But like, so if you are out buying property now, whether it's apartments, mobile home parks specifically, is what our our shows about, like, what can people do to lower their insurance rates or get a better rate, because it does matter now. It definitely matters. And now that prices are going up on deals, we need, to cut expenses as much as we can to increase NOI, because the deals are a little bit more thin depending on where you're buying them. So how can people do that?
Well, your reputation follows you a little bit, not only as an owner, but the reputation of the property now too. So
Mm,
used to not be, if Derek Vickers, who's a good operator and a good manager, and he's got a good track record, if he bought a property that had losses in the past, he kind of got those erased because they figured it was going to change. And today that doesn't happen so much. So you could be looking, I've had deals that were, you know, 2 months, 2 weeks from closing, that were blown up because of a liability claim that popped up. So you have to be a really good manager. You have to be a better manager. And I think we were chatting about this earlier. That when insurance company 7-8 years ago, when they sent you a note, hey, why don't you fix your sidewalk or make sure your steps or handrails? You go, yeah, okay, I'll get around to it. But today you really have to respond to those immediately, and you have to be very proactive with them. If you lose a good insurance partner, for instance, in our industry, there's about 5 or 6 really good package specialty manufactured home community insurers in the country.
hmm
And if you can fit within one of those programs because you've got a fairly good property and it's pretty well run, and it doesn't have too many old manufactured home rentals in it, etc., you're going to get a lot more for a lot less.
mm,
And if you've got a good reputation, sometimes you can squeeze into there where otherwise you wouldn't. For instance, if you got a property you're buying that's got 35% park owned homes and you're planning to sell them off and get them better, you might be able to fit into those programs that don't typically take that many park owned homes. If you've got a plan for getting rid of it and you show it right up front and you've got the record for it. So having a plan and what you're going to do, being very diligent about your risk management. I like high deductibles. You're forced into that in Florida now, where I know some of our park owners, the rest of the country, would be just shocked what you've got to eat as a deductible on a basic Florida property now. But I think that's pretty money well spent. If you've got a little issue in your community and you can get rid of it without just immediately turning it over to the insurance company, the insurance companies are training, and you know this, Derek, they tell you to turn in everything immediately as soon as it happens. The problem, if you do that, is you get a ton of losses, and it can just drive your rates up incredibly, even if they turn
mm.
out to be hardly anything. So, and it's a little tricky, and you got to be careful about it. But I do advise clients sometimes, if you got a small little slip and fall claim, and you can get rid of it yourself with a waiver and a release and a check for $2,000 or $3,000. I think that's a good investment as a business owner, even though your insurance company might pay the entire amount from the first dollar and hire the lawyer to manage it and do all that work for you, which there's a value to that. But there's also a real value to not being kicked out of those great programs where you really get a big bang for the buck.
Hmm. Yeah, that's interesting. And that's where it comes in with if there is some kind of slip and fall thing. Unfortunately, we have those billboards here in Florida that says, "Hey, slip and fall, I got somebody $1,000,000." So they're like, "Hey, let's take this all all the way." Right?
Well, I'll give you another example. So I've got a really good client and a growing portfolio, like a lot of your people are, and is a good operator, is a good person. And recently, they had a semi truck come into their park by accident, and it turned around. And when it turned around, it backed into the main gas above line distribution deal,
Oh,
and that
lovely.
rocked the whole thing underground. And now there's about 18 homes that can't get authorized to have gas in it.
Oh,
We built that policy to where he has some coverage for that above ground utility infrastructure coverage, which that's something tip to always add down. Make sure you get that. He's got some coverage for that. Probably has enough, but in this case, those big trucks have a lot of insurance, and that truck driver is gonna be responsible for that sooner or later. So he really had the option of either reporting it and letting the insurance company do all the work and then subrogate the claim back, or maybe just managing it himself up front in order to avoid a 50,000 temporary loss. Because even if that loss is paid by the insurance company and they get their money back to some extent or all of it, it'll still show up as a loss for X dollars because you get all the attorney and all that time into it. And when you've got a big portfolio, and let's say your insurance premium for your portfolio is $250,000, uh, maybe handling that $50,000 problem up front, at least temporarily, where you're out of cash for 50 grand, beats seeing your insurance premium raise 70 grand the following year, and then the following year, then the following year. So uh, it's it's you want to use your insurance, you pay for it, but you also need to be smart about it.
Mm, mm. Yeah, that's interesting. I never thought of it like that before. And so tell me about like this utility, this above ground utility infrastructure coverage. Is that like a separate policy that you
No,
get? And explain that a little bit.
well, we found over the years when our clients were getting hit by catastrophic things, particularly tornadoes and hurricanes, but lately more wildfires. And so
Mm,
they would come through, and we don't think about it too much, but at a mobile home park, those little pedestals that stick up out of the ground underneath each home, the homes connect to, those are about $1,000, $1,500 each to replace,
at least.
at least. And
Yeah.
if you And usually what you'd have is you'd have someone backed into one or one got knocked over and you would never report it. So you wouldn't for one, but when you have a major catastrophe comes through and you got a 100 space park and that's 100, and that's 100 of those, then all of a sudden it's real money on top of everything else. So what we
Hmm.
started doing some years ago was we added just a kitchen sink coverage to most of our policies that says above ground utility infrastructure. And it allows us to categorize a lot of different things that could happen as that. I think it's a nice coverage to add. And then you can put that on. Now, insurance is not good at covering things under the ground, like sewer pipes that break. There's a few reasons for that. I won't bore everybody to it, but it's not good for that. But by getting the above ground stuff, you get a little bit of connection to that, and you get some real value, especially in those catastrophic events. So I think if you're buying it, I like buying it. I like buying a lot of insurance with a bigger deductible versus a little insurance with a no deductible. That way, when you have those catastrophic events, so let's say, for instance, you're trying to decide, am I going to buy $500,000 of insurance and $1,000 deductible, or am I going to buy $1,000,000 of insurance with a $50,000 deductible? Well, with the latter, you're getting $950,000 of insurance. The former,
Mm,
you're getting $499, and your premium may not be much different.
mm.
And I think you're like most of our clients, Derek. If you have a $10,000 loss tomorrow, you're going to be pissed. You might even kick, the wall when you're walking out. But you're going to go home and have a glass of wine and go to sleep that night because you're going to survive it. What you really don't want to have is that issue where you've got a six-figure uninsured loss.
Yeah.
That's when you're going to get that phone call not only from your cousin who invested with you, but maybe some big other investor that said, "Derek, you don't know what the hell you're doing."
Yeah. Yeah. We don't want that. we
Yeah.
want to avoid those at all costs. And that's a good point because the above ground stuff can get expensive. The pedestals that in Florida, I mean, I think we're doing some for 3 grand a piece now, 3 or 4 grand, sometimes more than that. Depends on what they have to do, if they have to redo it completely. So that I know that stuff it becomes real money fast. And if you've got a bunch of them, that could be huge.
Well, and you got to watch out too on those prices because if you're like me, we all think it costs to fix something the last time we did it.
Yeah.
And the longer you're around, that might be 10 years, that might be 15 years ago. I built our office building, which is not a fancy office building. It's just a nice little office building, B space for a mobile home park insure that doesn't have many guests that come through. And when I built it, it cost me $90 a square foot, including the parking lot.
Mm,
Brick frame building, nice, what I call it, not fancy, but nice. And today it's 200 at least
yeah.
a foot.
Yeah. Yeah. And that's just like we've got 3 parks we're closing now, and one of them we're redoing the roads. And in 2021, this was a $40,000 paving job. 2 inches of asphalt, nothing out of the ordinary. Now it's $70,000.
Yeah.
And so I think that's a freaking great point that people need to understand is like, yeah, if something was this amount, a couple of years ago, you definitely need to rethink and get some quotes on that. That's a good point. That's a
Well,
good point.
it doesn't take an accountant like you to to know those numbers all add up, and they mean things. So even some guy from Oklahoma like me could figure that out.
Or a guy like me from Grottoes, Virginia. We have a blinking light in town. We have a blinking light
Yeah.
and a food lion grocery store.
Congratulations. Yeah. Yeah. We had two
Um,
lights in my hometown. We were a lot bigger than you guys. We were probably sophisticated.
yeah. I'm sure. Um, so on business interruption insurance, because we've bought stuff and we haven't gotten this. Banks, they haven't required it before, but some are requiring it more now. And so what's your opinion on that, and how, like, I guess just your opinion on it, and is it worth it if you had the choice of getting it or not?
Business interruption insurance is required by most of the sophisticated lenders out there today. All your Fannies, Freddies, your bigger investor stuff are going to just require it. So it takes it out of your hand. So what I like about it, I'll tell you this: it is hard to trigger loss of income coverage for a mobile home park, because really you have to damage the tenant-owned home so bad that they abandon it.
Mm,
So it's kind of hard to trigger, but when it is triggered, it's typical for those to go policy limits. So, from a perspective of a buyer of insurance, I like buying stuff that I'm going to need when it's a terrible situation, stuff that's going to make me keep afloat and not go bankrupt if I don't have it. So, if you don't have it and you're hit by that bad fire, that bad hurricane, that bad tornado, your investment is at risk of going bankrupt or being non-viable. The cost of it varies, anywhere from a half a percent or a third of a percent of your limit in some parts of the country, to in Florida sometimes it can be 5% of your income is what it costs you to do it in a lot of Florida properties right now. So um, I think you've got to consider it. What it does, a couple of things it does: it pays you the income you would have earned had you not been shut down by, let's say, the hurricane, by the wind. Watch your flood. Flood's always different. Plus, it pays you the extra expenses to reopen and get started again. So,
mm,
in a lot of times of a community owner, that's the cost to remove the debris of the tenant-owned home from the home site. Because
yeah.
you're in a bad situation if you don't have that, because not only is your income stopped, and not only have your tenants all left, but they've all left their junk on your home site, and it's going to cost you $3,000 a home site to clear it off so you can even begin to start. If you got 100 spaces, that's $300,000 before you can even restart. So it can pick up that cost for you too. So we don't see it triggered that often, but when it is, it's often policy limits, whatever those are for that deal. So it's a long answer. Sorry, it's not a perfect answer. I would
Yeah,
probably
no.
get it if I could get it reasonable. I would buy it. If I was a situation where it was just crazy because of my location or the kind of park I might have, if I was buying an all rental home park in Oklahoma where you've got a big wind risk, and I couldn't really buy it without buying it standalone on the market and having to pay 3 or 4%, I might not, but I would buy it for that half percent or 1% every time.
Yeah, yeah. Yeah, because we've got a few deals now that we've got to get it on. And does it make a difference on, like, so we buy in Florida mostly, and obviously if we buy on the beach in Clearwater, or right across the street from the beach in Fort Myers, I feel like that would be different. But we typically stay inland, out of flood zones, where it's usually more like just wind damage is really what we worry about. And we do a lot of tree work in the beginning to mitigate that, so we can at least eliminate the risk of these big oak trees that we have in Florida falling over, because the ground gets saturated because of all the rain, and these things, like, they can come down pretty easily. But does it matter? Like, would that make a difference in premium if you're on the beach versus inland?
It does make a difference how close you are to the water. We've got a few programs that'll do like 5 miles, 10 miles from the beach. They'll write when they wouldn't otherwise. But in Florida right now, all insurers consider all of Florida to be coastal, and because of and it's got to do with reinsurance companies categorizing all of Florida as a certain area. But yes, it does matter if you're in, you know, uh, what is it? It would be Eastern Orlando versus on the beach in Tampa. That does matter.
Yeah, yeah, I would imagine so. And yeah, it's always interesting when Florida gets, like my whole thing on the, the hurricanes and stuff in Florida. Yes, absolutely, it's a risk for sure. But if you go to all these Florida parks, these houses are 1950s, 1960s, 1970s. They've been through, Lord knows how many storms, right? And they're still there. And so I think there's something to be said about that. If you're not buying in I would just, I don't touch flood zones in Florida. Like, I just, I don't want to do it. But I feel like there's something to be said about that. That yes, it is a risk, but I can get more comfortable with it because of those various things.
I think you're right to avoid. Yeah, and flood zone. There's a right cost for every property out there. You know that from a buyer and from being a broker of them.
Yeah.
There's a price where you would buy it, but it's my experience that most people that are selling properties in high hazard flood zones haven't discounted them to the extent that they should. Because
Mm.
if you think it like if you're buying a community in a high hazard flood zone, your tenants may have to buy flood insurance if they're buying a home, or if not, they've got some risk whether they buy insurance or not. That might be $100 a month more it costs them to live in your park versus the one across the street that's 2 feet higher. So
Mm.
those things matter. And yeah, you're right. You've got to the risk. I always tell people, like in Oklahoma, you're probably never even going to see a tornado, but if you do, it's bad. And you look at from the insurance company's perspective. Am I going to have a loss? Let's say they charge you 1%. In Florida, they're not. They're going to charge you 4%.
Hmm.
So that means they expect one in every 25 years that you might have a big problem. Say 1 in 30, because they're going to make a little profit off the deal. So you kind of think long term for that too. You can not buy it and get away with it for 20, 30, 40 years, but then you don't. I think there was that famous story of that nice park in Florida that was pretty close to the water south of Tampa, and
Hmm.
the owners were taking their time selling it because it just price kept going up, and then they just got completely wiped out with one of those hurricanes. And I think they
Mm.
lost a multi-million-dollar park, and I don't think they had a lick of insurance on it.
Mm. Mm. Yeah, was that Fort Myers? Was it Fort Myers?
That might have been that Fort Myers area, and I don't know the name of the community, but I knew of some people that knew the story better, and I hope those people aren't on the line right now. But I understand it was just a really a bad situation where they had a property that was worth $50 million one day, and the next day it was worth raw land.
Yeah. Yeah. Yeah, I mean, it was crazy down there. Like we were, I saw some pictures from a park, and some of those parks, like the water was up to the roof of the homes. Just
Yeah.
freaking wild. It's crazy. But it also goes to show you some of these sellers, they get a little greedy when they could sell when it's hot, and then they, something happens. But so you would consider yourself like a specialty insurer? Is that correct?
I am. I don't even insure some of the stuff I own that's not mobile home parks. I just think insurance, if you can find the one that specializes in what you do, whether it's a dance club or an ice cream factory or a mobile home park, find that agent, find that insurer.
Yeah. Do you insure dance clubs?
No, I do not. And if I owned
Okay.
one, I'd call someone that did.
Okay. You look like a dance club guy, Kurt. I got
Yeah,
to tell
I'm
you.
I'm I'm stunning. I know. Thank you for the compliments. Yeah, I did hear a funny story one time. A guy was in my office trying to get me to sell insurance to men's clubs,
Hmm.
and I was like, "Oh God, that's going to be terrible. There's got to be people beat up all the time in that and problems." He goes, "No, no, no. No one was ever there," which I thought was pretty funny. I didn't do it, but I didn't want to have to make all those sales calls and have to explain to my wife why I was at Buddy's dance parlor all day long.
Yeah. Yeah. Right. Right. That would take some explaining to do. I'm sure. Do you see like, floods like getting triggered on policies a lot in parks? Like people, because people do buy in flood zones, and I know we touched on this a second ago, but do you see that get triggered a lot?
It does. Well, I have seen properties go underwater. But the flood insurance for a mobile home park is extremely expensive. None of the standard programs include it. If you're
Hmm.
going to get it, you've got to buy it through some sort of specialty program. And right now, there's one insurer in the United States that me and a couple of my friends put together and got them to do it. A couple of my good specialty friends to kind of work together to get them to do it. There's one in the United States that'll write loss of income with flood on a park in the United States.
Hmm.
And they charge about 4% of your annual income for that coverage.
Hmm.
So
Interesting.
yeah, it's tough. Now you can get coverage for buildings, and you can get coverage for your rental home inventory through the National Flood Insurance Program, and that can be pretty reasonable uh, and livable. But to just go out and buy through your Lloyd's of London carriers for loss of income, that's you've got to make sure that you can do it, but you got to make sure you're buying the park at a price that will justify that.
Yeah. Yeah. For sure. For sure. Yeah, I think it's this is an interesting world. The insurance world is always, kind of interesting to me because you have these actuaries that can like figure out the precise probability of something happening. It's always fascinated me that I heard, and this may or may not be true, that like these big life insurance companies, like they know based on a person's whatever, like how long they're going to live to a degree.
Well, they've got good tables that show estimates. Although those I was reading the other day in a life insurance journal that they could predict pretty closely, but they're missing it right now. The excess deaths across the United States are about 10-15% higher than normal, which is a
Huh.
huge variance.
Oh, wow. Wow. That's
Call
interesting.
call your friends at Aetna and talk to them about that deal there, Derek.
Yeah. Okay.
Yeah,
Maybe I'll give them a call.
yeah, yeah.
Um, do you guys do you guys insure any like multifamily properties?
We do some, but not a lot. Even being a apartment complex is are different insurers altogether. And we spend so much of our time developing relationships with mobile home specialty insurance companies. We just haven't gone into the apartment complex. We do have clients that own them, and we insure a few. We certainly have clients that own a lot of single family homes, and we insure those, and that's not a big issue. But apartments are specialty carriers, and they've gotten a lot worse than mobile home park insurance as far as how
Yeah.
much their rates have gone up.
Yeah, I mean, I've talked to guys that it's, 200%, 300%, like just crazy stuff.
Especially in Florida now that they're having to redo all those condo towers. It's not just people that investors that own them; it's the residents themselves, resident-owned towers. They're finding out their insurance went up 100, 200, 300%, and
Mm.
they have to pay it. And maybe they can't even afford to live there anymore. It might just be the cost of living with that view of Miami Beach.
Yeah, it's expensive down there. Like I was down there, I don't know, 8 months ago or something. And I mean, it's a different world. Like if you're going down 95 and you hit like Palm Beach Gardens, I feel like it's a line, like because South Florida is just way different. It's a different vibe. It's pretty cool. But it's definitely different down there and very expensive in Miami. Like I don't know. We were staying in Miami Beach, and I'm like, I don't know how these people that work at these hotels like afford to like even live down here. I don't know. It's crazy.
I was reading a story about a couple of nice towers in the South Florida condo towers where because of the new 30-year rule, they're having to come in and do major renovations, engineering renovations, which is going to cost these people bought these condo units for 300,000, and they're having to do an assessment of 150 grand each in order to redo it. So people are forced selling their units because they can't afford the assessment coming in just because they have to restructure the whole entire unit in order to meet code, or else everybody has to leave.
And what is that rule? A 30-year rule?
Yeah, in Florida now, after 30 years, you have to get your condo tower. I don't know how many stories that was above. You have to get it recertified by an engineer. And if they tell you you've got to come through and do $20 million of improvements to do it. You have to. You have no choice, and they'll give you 6 months or a year to do it. And if you don't, they close it down. It's all got to do with that, with the towers that collapsed and all the people died in it. If you go back and look at the history of that, they had engineers tell them, you guys need to spend some money and fix the shore of this thing up. And then they're asking all the, the retirees and the waitresses and all the people that live there, hey, kick in, 10 grand. And I go, I don't got it. So they're voting it down over and over again. And ultimately cost a lot of them their lives. But now they've made it mandatory. And so, I don't know, it might be a really good investment opportunity for some of you and your smart investors if you go out and buy those units, because now those units in those properties, you can't even finance them because they know there's a big assessment coming up. But a cash buyer could go in and buy them, pay the assessment, and then once they're done, now you can finance them, and maybe the value goes up another 50%.
Yeah. Yeah, that's interesting. Yeah, I didn't know about that, but I do remember hearing something about that because of that building that did collapse down there in Miami. So Kurt, like, what would you tell, as we start closing out here, someone that's going in to buy a park, what would you say to them as far as tips on getting insurance? How can they reach out to your team and get linked up with you guys or anything around that?
Well, if I tell all of our clients to call me, if you're looking at a place and you're worried about it for some reason, call me, or email me and say, when you got 10 minutes, let's talk about it to see if there's any real red flags that are going to be a problem. They're going to drive your insurance cost up quite a bit. So then call me on our 800 number, 800-458-4320, and call me on it. But you got to be real careful. You got to be careful about pollution, which never goes away. You got to be real careful about crime issues. Because right now, we never were asked the question 5 years ago, but today in some jurisdictions, if you get a high crime rate, you can hardly get insurance, period, much less expensive insurance. So you got to be real careful with some of those things. If you're buying a property with a lot of tenant, park-owned homes, you better know the condition of those homes pretty well, and you better have a plan for either maintaining them, improving them, or selling them to tenants. Or that'll put you in a really difficult category of insurance. And so you have to watch, always be a little careful what sellers show for their insurance cost when you know the prices are going up and they're going to change. And you know that maybe they didn't insure their park-owned home rental inventory, or maybe they've got some property and some flood. They carry no flood insurance. And you'll have to, because you've got, Berkadia on the line or KeyBank on the line that are doing your financing, and they're going to require it.
Yeah. That's great. Great insight. And that's why, like, I'm converting park-owned homes as fast as possible because I don't want them, because that extra cost is, it's a lot in many aspects.
It's a lot. So note all those little things up front. Yeah. Thanks. Yeah. I appreciate it.
Yeah. Hey, Kurt, I appreciate you coming on, and it's great to chat. And if there's anybody wants to reach out to Kurt, you can send over your info and we can put it in the show notes of this. But everyone, thank you all for tuning in to the MHP Show. We got a new episode every week, and just like and subscribe, leave us a comment, and we will see you all next week. Peace.